I'm Efrain Chavez. I'm a portfolio manager and analyst covering the basic materials. I joined INCA in June of 2012. And prior to joining INCA, I spent 4 years at a hedge fund in Connecticut. And I was a Latin American specialist covering all sectors. Before I spent time at the hedge fund, I spent 7 years at Goldman Sachs covering various Latin American sectors, mostly in the consumer, and I did a significant amount of portion of time covering the metals and mining space. I have a finance degree from Florida State, and I was born and raised in Lima, Peru. That's not the only reason why I was hired, just so we get it out there. So the next segment of our investment seminar is dedicated to us going through and taking a deeper look into 2 investment cases. This is intended to tie everything together. As you've heard today from Fernando about our philosophy and our process, we thought it'd be a great time for us to really dig deep into 2 cases, into 2 large holdings that we currently have, and really dig deep into how we do our day-to-day. So the first one is Copa Holdings. Copa Holdings is a Panamanian airline that connects the Americas. If you can see here on the chart on the left, intra-Latin American air travel is expected to be the second fastest growing air traffic region in the world over the next 17 plus years. So what I want to kind of detail in terms of Copa, and for you to understand a great example of what Copa represents, imagine yourself in Guayaquil, or if you're in Chiclayo, Peru. If you're in Chiclayo, Peru, and you need to get to Belize, there's only one viable option for you to get there, and that's using Copa. The reason that it's so important for us to highlight this is because Copa generates 75% of its revenue interconnecting Latin America. So how do they do this? They do this by having 74 destinations across 31 countries with 355 daily flights. This is quite an amazing feat. I was just recently in Panama, and to see them basically go through the airport and have them land 6 times a day, multiple airplanes, so that everyone can connect and shift to go to their other destinations, is actually quite amazing, and it's quite impressive. By the way, that hub, those 355 flights and the destinations of 74 different destinations, that's 3 times more than its next closest competitor, which manages a hub out of Bogota. Now, I also want to highlight that Copa is a stock where we feel we can develop an edge on. It's a mid-cap that is off index, and it's not very well covered by the sell-side analyst. And the reason I say that is because if the Latin American analyst, they'll cover it with an analyst who covers multiple sectors. Actually, some airline analysts there also cover the likes of Localiza. They'll cover industrials in general, some other transportation type names, and they don't have a specific focused airline analyst. Now, when you shift to the US, it's covered by a US airlines analyst that also covers the likes of United, American, that monopolize the majority of their time. So for us, this is a stock where we feel we can develop an edge. And the reason I say that, it's not because I feel that we can build a better DCF than our counterparts on the sell side. It's really because for us, it's critical to understand the franchise value of these businesses. We have analyzed Copa for multiple years. We've met with management. We've actually consumed their products. So for us, it's critical to understand that so that we can monitor it for the right investment opportunities. But let me turn it over to Daniel so he gives you more insight into the franchise value of Copa.
All right. So in terms of the franchise strength of Copa, and I think it comes down to, when you really summarize, it comes down to something similar to Localiza. We're talking best-in-class profitability with best-in-class financial strength and balance sheet. So how do we get there, and how do we get to Copa being the most profitable player, the best player really amongst its peers? Well, Copa's edge really lies in servicing more small cities, less traffic routes, where they can really dominate the market and make it very difficult for any competitor to feel worthwhile being the incremental operator. Now, 76% of the intra-Latin American routes have less than 20 passengers per day, making the point-to-point service unprofitable and in turn making Copa's hub and spoke model ideal. Now, furthermore, Panama as a city is the best connection hub in Latin America, given its geographical strategic advantage of being located at the very center of LATAM. In addition, the airport in Panama City is located at sea level, providing advantages in fuel efficiency as aircraft engines operate better in higher air density. So as you know, fuel cost is the most important operating cost for any airline, representing around 27% of revenues for Copa versus an average of around 32% for its peers. So it's a respectable 5% cost advantage there. So against this backdrop, this is a company that we really want to own, given its competitive advantage in servicing this inter-Latin American traffic, which leads to its best-in-class profitability with the added strength of a solid balance sheet. Now, this profitability outperformance is even more stark when you compare it to the Latin American peers, which you can see in the chart with the blue lines. In 2015, for example, which as we know was a very difficult year for Latin America in general, Copa was the only profitable Latin American airline, posting a net margin of 9%, much higher than any of its peers, all of which posted negative net income margins. So I think the charts again on this slide really drive home the point where Copa, you can see on the left, Copa's historically leading operating margins, even when compared to the global low-cost carriers, which are represented by the gray bars. And then on the right-hand side, you can really appreciate Copa's financial strength, operating with very, very low financial leverage compared to its other Latin American peers.
It's great. As we start digging into the next steps of our investment process, I want to take the time to go in through our screening process and idea generation. As we mentioned, these are stocks that are combined 60 years of experience. These are names that we are constantly monitoring, looking for, meeting with. And for us, when we see episodes of very sharp corrections in share prices, that's what attracts us. That is the initial flag that is raised so that we can go in and, having already done the work and understanding these franchises, we look for these opportunities. For Copa, it gave us two such episodes more recently, starting in 2014, which I'll let Danielle go through some of the more details around those.
Correct. So as Efrain mentions, this is really kind of you have two, really, if you break it down, there's an initiation of the position, 2014. That was the first opportunity. And then a different opportunity further down, like a year later, in the end of 2015. And we'll go into more details. But in terms of the initial position, the initiation of the position, the end of 2014, it had to do with what caught our eye was obviously the first 40% drop in Copa's share price. And the reason for this was that at the time, the situation in Venezuela became really unstable. This is probably the worst economy in the world, with GDP contracting 10%, inflation in the 800, 900% per year, the highest inflation in the world. So the situation there became really, really difficult. And the importance for Copa was that it was an important market for Copa. I mean, even though Venezuela represented 15% of revenues, which is already a healthy amount, it was the most profitable region. And to give you an idea, Venezuela operating margins were around 38% versus the rest of Copa at 19%. Okay, so it was definitely a big deal in the terms that it was important. I mean, it was significant. Then the fact that the government started with the capital controls and kind of the effects in transferring money out of the country became an issue, and Copa had around $500 million stock there. So all these reasons were good reasons for the stock or for the investment community to be concerned. But in our opinion, a 40% drop was way more than overdone. So that's where we initiated our position, the end of 2014. So then we go into a 2015 year that, as many of you know, it was just a very difficult year for Latin America in general. Now, even though this Venezuela situation, which was our initial position, our initial reason to get in, even as that situation began to stabilize, as Venezuela became just a smaller portion of Copa's business, as Copa, the company successfully rearranged capacity into other countries and other regions and other routes, and made Venezuela, less important to their whole business. And kind of the evidence for this is that for fiscal year 15, Venezuela now represented only 2% of Copa total revenue. So even as that became improved, I guess, or began to stabilize, a whole new set of problems arose in 2015. The first and most important one was the sharp devaluation. Latin American currencies sharply evaluated against the U.S. dollar, mostly driven by U.S. Federal Reserve-driven actions and other reasons. But this very sharp devaluation of Latin American currencies was the main reason for Copa's underperformance in 2015, as I'll explain a little later in more detail. Second, the Brazil economic recession took a turn for the worse, and Brazil represents around 13% of Copa's revenues. And lastly, commodities as an asset class just entered into a very nasty bear market in 2015, as we know. And as I think we've made very clear, we do not see Latin America as a commodity bet, but there is definitely a market perception that as commodities go, so does Latin America. And if you add to that, the FX devaluations, it was just a very negative scenario for Copa, just because of being in Latin America. Now, all of this, what all of this resulted in was in us significantly increasing our position towards the fourth quarter of 2015 and the first quarter of 2016, as the valuation for Copa became increasingly more attractive to us for reasons that we thought were completely cyclical and sentiment-driven and not strategic or company-specific. So at the beginning of 2016, Copa became one of our highest conviction ideas.
Great. So far, we've identified a company that we really like, that has had a severe correction in terms of price. And now we've identified why that is, but we take great care into analyzing not only the stress points, but we also want to really hone in on how these factors are being translated into the financial results of the company. So for us, this was critical to focus in for Copa. And I'll shift it over to Daniel, so he goes into some of the detail on how these impacts were really relating to the results that Copa was posting.
Right. So as we roll up our sleeves and did some of the work, and I want to expand on this slide. Why did we feel Copa's share price was so low? And really, the main problem was that Copa's pricing power came under severe stress, just given the adverse FX scenario for all of Latin America, as I mentioned before. Now, why does FX matter? And the reason is that the dollarization of airfares makes fares in local currency very expensive. So airlines, they can't push through price increases at the same rate that the currencies are depreciating, especially when the depreciations are very, very sharp. Eventually, in the long term, they can, but when it's so sharp and so quickly, they can't. And I think this table on the left can really show you just how sharp and how steep some of these devaluations were in 2015. And so naturally, an airline can raise prices in local currency 30, 50, 80%, just because the dollar strengthened against these local currencies. And the reason they can't do that is because their customers, they don't earn in dollars. Their customers earn in local currencies, okay? So besides that, at the same time, demand volumes began to weaken, basically from a weakening consumer position as the situation, the macroeconomic situation in Latin America as a whole also began to deteriorate. So those were the problems on the revenue side. Then on the cost side, most of the costs are denominated in dollars. And that's what really drives the dollarization of airfares, right? So but what I mean by dollarization of costs, well, for example, a debt service. So all of Copa's debt is denominated in US dollars. Now, that's not as big issue as it sounds, because as I mentioned before, Copa operates with very little leverage, and also their blended interest rate is less than 3%. So it's not really an issue. There's not a solvency issue. There's not a liquidity issue. But again, when it comes to sentiment, any Latin American stock that has U.S. debt, is going to be targeted, right? What else? Maintenance and aircraft spare parts. That's all in dollars. And of course, the most important, fuel cost, is obviously dollarized. So this is what happens with costs. So that unlike ticket pricing, which has a lag in pushing through currency depreciation, costs do adjust immediately, right? So the net result is a sharp contraction in consolidated operating margins, which is what you can see on the chart here on the right, where Copa's operating margins go from historical average of near 19% down to a never seen before level of 12%. Very quickly, you can see how sharply that happened in 2015. Okay, so in order to kind of recap what the negative market consensus view was, 2 points. One, Venezuela risk is too high. Copa's business in the most profitable region is quote unquote going away, right? And then secondly, this sharp Latin American devaluations, who knows? I mean, they'll probably get worse. And the market believes that this new very depressed level of operating margin of 12% will be the new normal for Copa going forward. Okay.
So great. So now the next step of our process really takes us on to take on this negative market perception. So not only the perception, but also now that we understand the stress points and how these are translating into the financial results, we take great care to use our analysis toolbox, if you will, to roll up our sleeves and go through and develop an investment thesis. A thesis that allows us to gain conviction, to go against the market consensus, that negative perception, and for us to be focused on how that thesis will translate eventually into financial results. So Danielle is going to take us through the example of Copa on a detailed basis through all the tools that we use for this analysis.
Right. So against all this market bearishness that I spoke about, what kind of work did we do to challenge this negative market perception? There's a few tools, like Efrain mentioned, that I think are worth expanding on. The first will be the earnings per share normalization. So after kind of taking out non-recurrent charges that are stemming from adverse FX impacts as well as asset write-downs in Venezuela, we arrive at a price-to-earnings valuation of 9 times, which was a 30% discount to Copa's average historical valuation of 13 times and to a theoretically justified PE valuation of 15 times based on a sustainable ROE of 20% for Copa and a cost of equity of 9%. So in short, Copa's valuation became unusually cheap for a company of this high quality, okay? So second came our modeling. So we needed to get an idea of where could we reasonably expect Copa's operating margins to settle in the future, right? So we broke down operating margins into its revenue components, being pricing, capacity, volume, demand, as well as its cost components, which will be split between fuel and non-fuel factors. And we kind of came to the conclusion that the main driver for Copa's consolidated operating margin contraction was pricing, and that even if we used conservative assumptions, we should expect Copa in the long term to eventually be able to normalize its pricing to adjust for volatility in currency impacts. So we forecasted that by the year 2018, operating margins could recover to a level of 15%, up from the very depressed level of 12%. Now, this 15% we believe is very conservative. You got to keep in mind that the historical average is near 19%. The historical peak operating margins is around 21% back in 2012. So we settled at 15% conservatively. We did think that the impacts in Venezuela could be more long-term, more prolonged, more structural. And so when the company did recover operating margins, maybe they would settle at a level maybe below historical average, even though there's a lot of growth, as Efrain mentioned, second fastest growing region in the world in terms of air traffic. So 15% was our conservative assumption. Then came our upside potential calculation. In essence, based on our modeling assumptions, where do we think the stock should trade in order to be fairly valued? And this upside potential calculation has basically 2 components. The first will be earnings upside or an earnings power EPS estimate, and then accompanied by fair valuation multiple that we should assign to it, okay? So we arrived at a fiscal year 18 earnings upside EPS or earnings potential EPS of $7.75, which represents an earnings compounded annual growth rate of 16%, which further breaks down into a revenue compounded annual growth rate of 16%, and then a net margin expansion up to 13% from the currently depressed 10%. And for reference, the historical average is 16%. So again, just being conservative here, right? Then we apply a 13 times fair value PE multiple, and this is based on Copa's 10-year historical average PE of 13 times, even though, as I mentioned, the theoretically justified PE could be argued to be higher. But again, to be a little more conservative and give ourselves some cushion, okay? So this combination of the earnings estimate and the valuation multiple resulted in a potential share price of $103.85, which, including dividends, equaled a return of 60% in real terms, or 17% annualized. All right. So lastly comes our matrix of comparable analysis to answer the question, okay, so given Copa's valuation and earnings upside and share upside, potential upside, how does that compare to its peer group, right? So we came to the conclusion of this analysis that Copa was trading the cheapest of its investable universe, even though, as we've explained, is the most profitable player, which naturally kind of begs the question then, why then Copa get hit the hardest then out of all the players if it's the strongest one? And there's several reasons, I guess, to explain share price fluctuations, but I think one that's worth highlighting is that perhaps the fact that Copa is the most liquid Latin American airline stock by a factor of over 10 times kind of made it a focus and made it a kind of a target really to foreign short sellers who were looking to express a generalist negative sentiment, negative view on Latin American currencies. Forget Copa and airlines, just currencies. And they were looking for any liquid vehicle to do this. And Copa kind of fit the bill in that sense. So, and the evidence for this is that Copa's short interest ratio rose to almost 25% of its total float, which is just a staggering short interest level for any stock. So the point is that this enhanced selling pressure on Copa made the stock the cheapest of its investable universe, and in our view, provided the highest potential upside with the lowest amount of risk. All right. So in order to kind of recap the two main points of our investment thesis, is that first, we expect Copa to recover from a large decline in operating margins, given our view that Copa will be able to increase fares as the environment stabilizes. Again, in the long term, it will normalize. Second, Venezuela capacity will be shifted into other countries, other regions, other routes, and Venezuela eventually will become a non-factor for Copa's overall business and long-term profitability. All right, so that kind of summarizes our thesis. Now, before moving on to the next slide, I would like to let Efrain comment on a couple of important points regarding our investment process.
Sure. So now stepping in and giving you some more insight in terms of the process and how it works. Now that Daniel has been championing this idea and he's done all this work is all shared with the entire investment team. Now, but in addition, what we do is we assign someone called the devil's advocate. Now, I know Fernando had mentioned it through his presentation in terms of what the devil's advocate role is. And their role is to poke holes into the thesis. I think he called it a professional heckler, which I think I like that. And actually, in this case, it happened to be me. I was the professional heckler for the last increase that we did with Copa. This is a company that I know very well, that I have had lots of history with. So for me, it was great to be able to take the other side of the discussion. Now, what we do is we circulate all this information to the entire investment team. The devil's advocate is able to present their case as well, and it all culminates into a meeting where we open it up for the championing analyst, the devil's advocate, and the rest of the group to voice their opinions and discuss the merits of the investment opportunity that we see. Now, we come to a conclusion, as Fernando kind of described, in terms of not as a voting, but we reach a consensus given what the experience of the collective group at that time. So moving on to the next part of our investment process, this is monitoring and how we go about monitoring our investments on an ongoing basis. Now, Fernando mentioned through his presentation that we are not, the purpose is not for us to see whether or not our earnings estimates are a penny or two off. It's for us to get the data points that are being provided by the company in order to see if those catalysts that are being given to us are proving our investment thesis or are supporting our investment thesis, or if we need to go and figure out why these things are not working out in this way. For Copa specifically, as Danielle has mentioned, we were taking on the negative market consensus that they felt that the new normal for operating margins would be 12%. The work that we did, all the investment analysis that we did, led us to gain conviction that this was not the case, that they would be able to recover their margin, the margin upside that we saw. So I'm going to let Danielle go through and give us some update, some progress report on this, on how this investment has worked out so far.
Absolutely. So, and in terms of just to add a key point in terms of the monitoring, I think it's important to mention just how much contact we have and interaction we have with company management. I mean, around 6 times in this past year, just our interaction with the company management. We went in April and sat down one-on-one with CEO. We just came back from the investor day in Panama 2 weeks ago. We've been going to the last 4 investor days for Copa 4 years in a row. So dating back even before we were involved in this name as a position. So just to give you an idea of our interaction, and that's how we spot opportunities, because we know these companies real well. And then when the price really kind of gives us that opportunity, we've already done a lot of the work. All right. So in terms of key updates, first of all, the stock has been one of the best performers for us this year, up over 80% year to date in US dollar terms. And I'll explain what that has done to valuation in a second. But it is important to mention that the stock has been moving up for fundamentally good reasons. I mean, the company's making smart decisions, and we've also seen volume demand start to recover. So in terms of the decision making for the better part of a year, Copa has been working very hard at reducing capacity in order to improve its load factors, right? So especially in the weaker economies that it operates in, such as Brazil and Venezuela at the moment. So in terms of the specifics, the capacity for Brazil has been reduced 25% year over year and 20% for Venezuela. So what this has done, it has pushed up the load factors, which is an industry term for utility or capacity utilization, up to 86% this past July, which is the highest level for Copa since its IPO. All right. So and then in terms of passenger demand, we're now seeing some green shoots and we're getting some hard data that leads us to believe that we've reached the bottom and we're starting to recover. And this comes back to monthly reported data from Copa in terms of traffic statistics. And the past 3 months in a row, we've seen double-digit growth in volume demand year over year. And kind of to give you a little bit of the specifics, August, which was the last reported month, we'll get September, I guess, in a couple of days. August grew 13% year over year, July up 11% year over year, June 10% year over year. So we're getting a nice little trend here of very good, very encouraging data, hard data, as far as volume demand starting to pick back up. And lastly, management on its latest earnings call raised its full year guidance and believes that they confirmed our view that 2015 was in fact the bottom for operating margins. Okay, so those as far as key updates. Another thing that is very key to our monitoring and our investment process is tracking valuation levels in order to reduce or add to our positions. For Copa, after an 80% year-to-date run, obviously that has also pushed valuations levels higher, as is natural. So Copa's current valuation stands at 18 times versus what I've mentioned, a historical average of 13 times and double our entry of 9 times. However, we still believe that Copa shares remain very much undervalued given the growth that we expect in earnings from a very low base. You have to keep in mind that 2015 EPS was down 51% year over year. So that's the base that we're working with, okay? And then in terms of an earnings CAGR, now I talked about how conservative our 15% operating margin assumption is. That generates an EPS earnings CAGR of 16%, which if we just use that, I mean, compared to a valuation of 18 times, that still results in a very attractive PEG ratio of only slightly above 1. But going back to that 16% CAGR and how conservative that is, if we take the historical average, which is 19%, we're using 15% conservative, right? If we use the 19% operating margin historically, we get much more upside. And again, the question becomes like, well, can we get back there, right? And the thing is that just coming back from the investor day, management really believes and has communicated that they do think that they have very strong reasons to recover margins by the year 2018 back to 18-19%. They really believe that, and they also have good reasons for that. I think without going too much into the specifics, which I'm happy to do in the Q&A session panel later on, just with the fuel hedges rolling off, right? So Copa has historically hedged 40% of their fuel, and obviously when oil crashes, they lose a lot of money on these hedges. So if oil prices stay just stable here and they'll go up or down, just stable from here, that's a 200 to 300 basis points of tailwind that they'll get from that in 2017 already. So that would make our 15% operating margin assumption already kind of low when you factor in all the growth that comes from the region, and also some of the other factors like ancillary revenues and some of the other initiatives that they're taking. So return back to just the historical level. Management's not saying we're going to new highs, just to historical, that 18-19%. If we price in and a recovery by the year 2018 of 18.5% operating margin, then the potential share upside in real terms from the current price after an 80% run is still 51%. Now, it's also, by the way, yes, the stock has rallied 80% this year, but it's still over 40% from historical high. So again, this comes back to the chart we saw for Latin America of like, have we missed it? No, I mean, we're talking for very depressed levels that we've seen these gains, right? So that applies to Copa as well. So I guess in conclusion is that the fact that even though the stock has done very well for us this year, we believe that there's a lot of upside and the shares remain very much undervalued. And that's why it continues to be one of our biggest positions.
Thank you, Daniel.